Who's the largest private landowner of farmland in the United States? Bill Gates. Over the last 10 years, he has acquired more than 269,000 acres of farmland. That's a freaking lot of farmland, but, well, relatively speaking, to put it in context, there's over 900 million acres of farmland in the US. And his buddy Warren Buffett, well, back in the 80s, he bought a farm in Nebraska that produces soybeans and corn, and his reasoning behind that was there was basically no downside to an investment in agriculture, while there was potentially substantial upside. That's his own words. Now, historically, it's been hard to get exposure to farmland, unless you've got the money to go out there and buy a farm. And right now, I know that just a little bit over 50% of the US population owns stocks, while less than 0.5% of the US population has exposure to farmland. So it's an asset class that not many investors have exposure to, but it's still a pretty big freaking asset class overall. It's about $3 trillion in the US, about $10 trillion worldwide. So we're going to take a look at the performance, the returns, and jump into farmland investing. Now, if you had invested $100 in US farmland on January 1st, 1991, using the NCREIF Farmland Index, yes, there's a farmland index as a proxy, your investment would have grown to $2,158 by a year-end 2020. So that's an increase of 21.1x. Now, in comparison, a $100 investment in the S&P 500 would have grown to just about that, $2,052 over that same time period. But as you're going to see here when we look at the chart, farmland has done so with a lot less volatility and drawdown. But first, let's talk about how farmland earns returns. There's a few ways that farmland actually earns returns for you. First is appreciation of the underlying land, capital appreciation. The value of your land goes up in value. Second, there's land rental. And this was actually pretty surprising to me. Actually, about 40% of US farmland is rented or leased. Going into this, I thought that it was crop yield, but that is not the case. As a farmland investor, you are primarily going to rent or lease the land out to farmers or farm managers that are going to earn the crop yield, and that is their risk, their return, they earn that. And they're taking on the risk of commodity prices, and let's just say climate or weather conditions, or whatever happens when your cornfield gets some type of pest problem, etc. So your return or your yield on the land is kind of stable, it's a rent, really, right? So it's not going up or down with commodity prices. And I think, that's good for you as the investor because it keeps things stable, but you also don't get the upside on it. Now, I have seen or heard of some talk of rent/lease prices being based on the crop yield, but those seem kind of few and far between. Primarily as a farmland investor, your return is going to be earned through capital appreciation and land rental. Now, interestingly, I found this chart here from Hancock Agriculture, who does a bunch of research into the farmland world, so their website is a pretty good resource. In this data here, based again on NCREIF Farmland Property Index, so that's going to be, NCREIF Farmland, whatever their indexes are publishing are going to be the main data sources for anything farmland. But anyways, it shows the breakdown annually, what percentage of the return is comprised of income, what percentage of the return is comprised of appreciation. And you can see appreciation in land goes up and it goes down, whereas income remains fairly stable. It does go up and down, but it's fairly stable. Now, what is really stand out to me here in this chart is in 08, 09, we don't really see any decline in appreciation. That's certainly very interesting to me. And we'll look at some other charts that show the land value and the changes in land value over the years. Okay, so historical performance. Well, AcreTrader has taken NCREIF data for the Farmland Index and put together this cool chart right here, which compares the total return farmland index to other asset classes. And we can see farmland being this green line right here that goes up nice and smoothly, slightly outperforms the S&P 500 over this 30-year time period, as I mentioned. And notably, you can see, while the S&P 500 has a huge drawdown right here for the 08, 09 crash, farmland just seems to kind of smoothly chug along and keep going up. Now, interestingly, the only asset class that did better than farmland over this period, and this was a surprise to me, I didn't realize this, was real estate, or REITs, broad market REITs. And just look at this. We can see they kind of balloon up in 06 as you would expect, and then they start coming down for 07, 08. But then they keep going right back up. I didn't realize that REITs had just such a bull market run for the last 30 years. Just really didn't realize that. But again, they've done so with less volatility. I believe that the volatility over this time period for the S&P 500 was about 16.7%. And roughly speaking, the volatility of an investment in farmland over this period was about 6%. So about 1/3 or 2/3 less volatility, we should say, for farmland investment. And now we don't see any of that drawdown here that you get with other asset classes like equities or REITs. Now, this cool paper here from Acre Trader shows the average annual return going back to 1991 through the end of 2018. So this wasn't based on the full data that we have now currently. And even then this isn't currently. This is just through year end 2020. Right now it is beginning of year 2022. So there's still 1 year of data that we don't have that's not on this chart. This one here, though, from 91 to 2018 shows an average annual return of about 11.5%. We can see all years are positive, so NCREIF data certainly makes things look good for farmland. 2005, just a huge year there for farmland. 2013, also a huge year. 2001, that would have been when the dot-com crisis happened. Not a good year for farmland, but still better than it was for equity investments. And if we go down a little bit further, we'll see this chart here, which takes data from somewhere else. We'll dig that up in a second. I think it's USDA. And it shows the annual returns of U.S. farmland underlying value excluding crop income. So this is just looking at data for the actual value of the land. The average annual return for farmland is 6.1%. This is not including the crop income. And we can see it had a little bit of a bull market here, or excuse me, a bear market in farmland from 1985 to 87. I guess you could also kind of stick 83 in there, call it the 83 to 87 bear market in farmland. And then interestingly here, it does have a drop in farmland value in 09. So this has got to be a different data set than what I'd shown you in that chart that showed the return or the income return and the capital appreciation of farmland. So different data sets can do different things. It's always very important to consider your data set. So when we look at this here, we can see this two interesting takeaways from the chart above are: one, farmland values have only declined in 5 years over the last 50 years. And two, from 1985 to 1987, that farmland bear market, farmland value saw a significant decline during the interest rate and oil crisis of the time. Keep in mind, however, this is just the value of the land itself. During those same years, 1985 to 1987, the cash rent yields were still roughly 5 to 8%. Said differently, during the full-blown farm crisis of 85 to 87, the average annual negative return to the farm owner was only around -3%. Had the owner held on to that land, the land itself would be worth more than 400% more today, and that's before accounting for the accumulation of annual cash dividends on top. And what is the data source here? What is the data source? All right, data, if we look at it from the USDA. So the USDA, and we got some more data coming up from the USDA. They also keep data on farmland. And you know what? I guess we'll just look at that now. One thing to keep in mind here is this is a total return or a broad market total return index that we're looking at with NCREIF data and also USDA data. This data right here, not that one right there from the USDA, shows that there's huge differences in returns by type of land and by region. So like if we look at this, what is it? The farmland real estate average value per acre, by region states in the United States from 2017 to 2021, we can see the percentage of change from 2020 to 2021 for the Southeast was 2.7%. The value of an acre there on average went up 2.7%. Whereas in the Southern Plains, it went up 9%. So keep that in mind when you're looking at any type of index data. More narrow holdings can vary wildly. Right, as we just saw right here, Southeast up 2.7, Southern Plains up 9. Things can vary wildly, whereas the data we're looking at here in these charts is a broad market index. If you're investing in farmland, there's really no way to invest in the index as a whole, right? Like you can invest in the S&P 500, that's easy. Those are liquid, exchange-traded securities. Farmland, you're going to be investing more in specific properties or specific companies that have exposure to farmland, and even those companies are usually going to be regionally based. Anyways, going on from there, Hancock has this cool chart which shows the annualized return and standard deviation or risk of different asset classes. So we can see U.S. farmland here kind of on the left side of the scale when it comes to standard deviation. So they don't have as much volatility as large cap equities or small cap equities or international equities. Meanwhile, they're up about as high as them in total return from 1971 to 2010. And Hancock also keeps some data that they're using to generate this information. Actually, let's see what the data source is specifically here. If we go down to the bottom of it, yeah, all right, so it's their own Hancock Broad Farmland Index 1971 to 1990 for that data, and for 91 to 2010, National Council of Real Estate Investment Fiduciaries Farmland Index. So, okay, there's a few different farmland indexes out here, and that's what they're using to comprise this data. So farmland, both being, less volatile, less risky than equities, and also nearly or equally or on par in higher return. If we come down here, we can see all of this data as you would expect for something that is on this side of the risk profile scale and this high up in return. Farmland does have a pretty damn good Sharpe ratio, 0.86. It's about a little more than twice as high as large cap equities. Anything else cool in here? The correlation chart. This is pretty cool, right? So this shows the correlation of farmland for this time period, 71 to 2010, the correlation with other asset classes. And we can see with equities, it has a negative correlation with equities. And, getting a negative correlation with equities is really hard to do in a portfolio, right? Most portfolios for most investors is comprised majorly, I'm not exactly sure what word to say here, but it's the majority of most investor portfolios is equities, and getting anything that has negative exposure, that is difficult. Even bonds typically have some correlation to equities. Farmland here has negative correlation to equities and bonds. The only thing it does have positive correlation to is real estate. That's understandable. And then inflation, I don't even know what you'd consider that as an asset class, maybe tips, I guess. So farmland presents huge diversification benefits. And finally, I found this cool chart right here by this company, Nuveen, and it shows U.S. economic recessions on a chart of the NCREIF Farmland Total Return Index. And you can see that during recessions, farmland just kind of seems to keep chugging along and keep going up, which again, that's characteristic of its diversification properties. Okay, so farmland returns look freaking awesome. What are we missing here, and what are the risks? Well, first of all, one thing I want to point out is that the data set for farmland is really limited, right? Like when we look at this chart, it only goes back to 1990. In the grand scheme of things, that's just a really small period of time. Now, Hancock here in this document, they do have some other data going back to 1971, but there's still really no way of knowing just how good of a data set that is. And I think a lot of people, when they're analyzing investments or any type of data, they don't consider the underlying data set. They just kind of take it at face value, and they assume that it's 100% accurate and 100% comprehensive. When in reality, prior to 1990, maybe there just wasn't so much data. And not maybe, there probably wasn't nearly as much data available, right? So they didn't get a full and adequate sample size or a full data set reflective of the entire market. They had limited data, pre-1990. That's one thing to consider. Also, notice how in this chart here, it shows that in 2009 or 2010, the value of the land appreciated. But that doesn't make any sense because we know that real estate markets, from 08 to 2010 were pretty much going down. Any type of land, any type of real estate was in a bear market at that case. So why is this thing showing it going up? And that's very odd. And that has to do with, I believe, the liquidity in the valuation of the actual land. Farmland is probably based on appraisal valuations, and very rarely do you actually see a bad appraisal on land. And at that, it's probably only appraised annually. I mean, maybe it's appraised, I don't know how they're getting these numbers, but it could be something where it's appraised, once every 2 years or something. And mind you, I'm just kind of making this up here, but it could be something where it's appraised once every 2 years, and then the next year's appraisal value is based on a forecast, right? That could be how they're getting the value of the land to quantify the appreciation that is used in the NCREIF Farmland Property Index. If you know how they're coming up with the value of the land, certainly let me know. But there's not a highly liquid market for farmland. That is my whole point. There's not a highly liquid market for farmland like there is other types of real estate. So you can get an accurate, or easily get an accurate valuation on the property. Here, they don't really have that. And I think that that's kind of creating a bias in the data set that shows, hey, the land value just keeps appreciating year after year. Now, interestingly enough, here in this data set from the USDA value, we see that in 2009 it did have a decline. So clearly there are differences in the data set, and that is one thing to consider. Number one, I don't think that, quite frankly, I don't think that an investment in farmland, or I don't think that the volatility of farmland investing is accurately reflected in this farmland index. That's just my opinion. Again, I could be right, I could be wrong, I could be overly right on it, but I don't think that the true volatility of the valuation of farmland is reflected in here. Now, you could make the argument that that's irrelevant because you're not just buying and selling farmland in your brokerage account day by day. So that is one fair thing to consider, but also too, the time period is a fair consideration. It's a very small time period, and interestingly enough, depending on when you start these charts, things can look different. Like if we started in 2000, if we just looked at the 20-year period from 2001, January 1, 2001 to 2020, this thing would absolutely crush stocks. It would look way better. Going back to 1990, it looks just a little bit better, but still obviously smoothed out. So there's certainly a time period factor here at play, and in this time period, farmland investing has done pretty well. As an investor, it's important to consider, though, what's going to happen in the future. Is this trend of rapid capital appreciation and income and growth in farmland as an asset class going to continue? Or is it going to fizzle off? Or is it going to decline? Right? All these charts are just, backwards looking, hindsight looking. What you have to consider as an investor is what's going to happen in the future. Now, what are some other risks, though, of farmland beyond, the data and the sample size that we have? First, you could have the growth of indoor farming and hydroponics, all that kind of stuff. I really don't know anything about it, but who's to say that going forward in the future, farmland is not dependent on land, right? What if we start growing our crops in tall buildings? I've even heard some wild stories about, hey, we could build these like floating ships, like floating warehouses, and float them around in the ocean, and it would help global warming because we could put plants on the top. Maybe that's probably a little bit ludicrous, but the bottom line is, who's to say that we need farmland? And also, who's to say that we need as much farmland, right? Because throughout history, as a population, we've been able to increase the carrying capacity of our planet here, Earth. Going back, if we took just the carrying capacity of Earth 200 years ago, it would not support all the people that we have on there, but through science and things like genetically modified organisms, and mind you, I'm not a scientist by any stretch of the imagination, but through things like that, we've been able to increase the carrying capacity and grow more food and more crops with less land. And then also there's globalized farming. So this data that we have is based on US data. Everything we've looked at is based on US data. But also most crops are grown fairly close to home because it's not as easy to ship them. But what if we start outsourcing the crop production? We start buying crops from other countries and importing crops. That would be a decline to the value of US farmland. And then finally there's liquidity. Now those factors we were talking about were more macroeconomic factors. This is more of a micro factor and just related to you as an investor. But if you invest in farmland, it's not like you can just go into your brokerage account, click the sell button, and boom, you've got some cash. No, you're going to be tied up in your farmland investment for a few years. All that said, there is still a very, very strong case for having exposure to farmland as an asset class. Let's just look at this chart here and assume some haircuts. In other words, let's just assume that going forward in the future, farmland doesn't perform quite as well as it has in this period in the past that this data is based on, right? So we say that the annualized return of farmland goes down a little bit and we pull it down a little bit on the chart. And then let's just say that the volatility or risk or standard deviation increases, so we move it to the right. Even by these measures here, it is still a high returning asset class that is highly diversified from equities. Now, with that, the actual amount of farmland available for use is declining. If we look at this chart from AcreTrader right here, it shows the arable land use per person. It breaks it up into a few different regions, and then the blue line represents the world. On a per person basis, the amount of farmland available is declining. Now, this is not driven entirely by repurposing of land or deforestation types of things. This is highly influenced by the population growth of the United States, or not the United States, but of the world. Global population growth has just been increasing for the last centuries, right? So yeah, this is influenced by population growth, but by and large in the United States, farmland is declining. There's a lot of information out there and a lot of reports you can find on it. We can see this here from AG Week, and I'm not sure the data source on it, but almost 31 million acres was lost to development from 1991 to 2012. Right? No secret here in the United States, we are developing and we are building a lot of things, and oftentimes that development and building comes at the expense of farmland. So there is a declining supply of farmland out there. Along with the declining supply, there's also likely to be increased demand coming from investors. Investors really haven't had much of an impact on the farmland market or had much exposure to farmland as an asset class historically, but that's changing. More institutional investors are getting into farmland. Individual investors can now get into farmland, and this is subsequently going to have an impact on the demand for farmland and then, well, the price of farmland. So I think considering that, farmland is going to be a relatively strong investment, just as it has been. Mind you, that's just my opinion. What do you think about farmland as an investment? Let me know in the comments below. Finally, if you want to invest in farmland without buying the whole damn farm, how could you do it? Well, there's two ways. The first is investing in farmland REITs, real estate investment trusts that are publicly traded and have a high exposure to farmland. There's two of them that come to mind. First one is Gladstone Land Corp, ticker symbol LAND, which has a market cap of about $1 billion. And then Farmland Partners Inc., ticker symbol FPI, which has a market cap of about $500 million. So you can invest in those two and get some exposure in your portfolio to farmland. Now, the one thing I don't like about them is that the price of them and the return that you're going to get is speculative driven. Because these are publicly traded securities, the price of the asset, the price of the stock that you're buying, the price of the REIT, is going to be trading at a premium to its underlying asset value. So you are not tangibly getting the returns of the underlying asset. You're not getting the return of the income. You're not getting the return of the appreciation of the land that you buy. Instead, you're getting the return of the stock price. So with that, when you're holding these, the volatility is going to be way higher than what we've seen here in the data, based on the farmland indexes. So keep that in mind. Yes, you will get exposure to that asset class, and if farmland as an asset class, really goes up in terms of price and valuation, you'll get exposure to that through these REITs. But at the same time, you could buy in or invest your money into these when the price, speculatively driven, is much higher than the underlying net asset value of these companies. The other way is through one of the few fintech companies that have popped up recently, such as AcreTrader, Farm Together, or what is this one, Farm Funder. There's these three that have came up. There might be more, but basically they let you browse through their portfolio, or not through their portfolio, but browse through investment opportunities as they come up, like AcreTrader has. What does AcreTrader have? AcreTrader has this one right now, which is a a farm not even in Spoon River. I was going to say it's a Spoon River farm. That makes no sense. There's no such thing as a Spoon River farm. That's just the name they give it. This farm in Knox County, Illinois, which does corn and soybeans, like Warren Buffett's investment, and has a gross cash yield of 3.2% and a net annual return of 8.1%, and a minimum investment to get in on it, $15,700. You can invest at least $15,700 in that. I think you have to be an accredited investor to participate in these, but with a relatively small amount in the investment world, you can get exposure to this farm here in Knox County, Illinois, and there are more offerings that come online every week. You could also browse Farm Together, or what is this one, Farm Funder, which has these investments that have closed. It looks like, I guess they don't have any open ones, You can sign up for their email list and get notifications of when the investments open up, and you can see the minimum investments. They all seem to be about the same in the $10,000 to $15,000 range. And while I'm not sure how Farm Funder and Farm Together work, Acre Trader here, I know that what they do is they pool everybody's money to buy the farm, and then they charge a relatively small amount for managing the farm. So somewhere on here I saw more details, like a breakdown of what they charge in management fees. And their management fee was relatively small. I think it was like 0.7. Yeah, we charge a flat annual administration fee of 0.75%. So that's a relatively small for their annual administration fee. I don't know if that includes, what it costs to actually manage the farm, but I'm guessing that really wouldn't matter because they're just going to rent the land out. So for 0.75, that includes them, handling the administration of the land. They probably have to buy insurance, some cheap insurance on the land, all the documentation, and then getting the farmland rented out or leased. And that, eats up at 0.75% of your investment, which I feel is a very fair fee for what they do here. And probably, I don't know exactly how Farm Together and Farm Funder work. Like I said, I haven't looked into them, but they probably work in the same way. So that's how you could get invested in farmland if you want to. That's a wrap, guys, on this video. I hope you found it helpful and insightful.